My name is Mr. 𝘍𝑃𝘂 and I lecture Advanced Financial Reporting and Analysis. Today, I want to take you through a topic in Advanced Financial Reporting and Analysis known as deferred tax. So in our session today, we are going to cover a subtopic under assets and liabilities known as deferred tax. I'm certainly sure that when you are doing your financial reporting, you came across deferred tax, but in financial reporting level, you only cover the basic aspect of deferred tax. At this level, we are going to go through deferred tax, which is inclusive of the group or the consolidation aspect. Therefore, at this level, we are going to advance a bit and go through deferred tax inclusive of a group aspect. Now, I want to take you through the introduction. So, introduction of deferred tax. Introduction. Then you write below that. Deferred tax is a future tax obligation, arising from transactions taking place in the current accounting period. Arising from transactions taking place in the current accounting period. A paragraph below that. Deferred tax is caused by temporary differences. Deferred tax is caused by temporary differences. Then you write below there and say, temporary differences are differences arising. Temporary differences are differences arising as a result of the difference in policies, between the accountant and the tax authorities. Between the accountant and the tax authorities. Full stop. Temporary differences are broadly classified into two categories. Temporary differences are broadly classified into two categories, namely number 1 and number 2. The first one is known as taxable temporary difference, and the second one is known as deductible temporary difference. We are going to start with the taxable temporary difference. We are going to start with the taxable temporary difference. Then you write below that and say, taxable temporary difference is the one we are starting with. It arises when the carrying amount of an asset, exceeds its tax base. The carrying amount of an asset exceeds its tax base, or when the carrying amount of a liability is less than its tax base, full stop. The tax consequence of a taxable temporary difference, is known as deferred tax liability. So that's the first type of temporary difference. When we talk of the carrying amount of an asset or liability, we are simply referring to its net book value. That is the cost minus accumulated depreciation, or the amount at which the asset or the liability is carried in the accounting books. That is, figures as per the accountant. On the other hand, when we talk of tax base, it is the amount at which an asset or a liability is subjectable to tax. Therefore, it is simply the taxman book value. It is the tax book value. Now, the other type of temporary difference is known as deductible temporary difference. Deductible temporary difference. It arises when the carrying amount of an asset is less than its tax base. It arises when the carrying amount of an asset is less than its tax base. Or when the carrying amount of a liability, exceeds its tax base. The carrying amount of a liability exceeds its tax base. Full stop. The tax consequence of a deductible temporary difference, is known as a deferred tax asset. Full stop. Then below that, basis of accounting for deferred tax. A subheading, basis of accounting for deferred tax. There are three bases used to account for deferred tax. They include number one, we call it the nil provision basis. Others call it the flow-through method. flow-through method. Other books refer to it as the flow-through method. Under this approach, deferred tax is accounted for. Deferred tax is accounted for only to the extent that the timing differences are expected to reverse within the foreseeable future. Within the foreseeable future. Full stop. The main advantage of this method, is that it is simple to understand and apply. It is simple to understand and apply. Full stop. The main drawback of the method, is that it ignores deferred tax. And hence not realistic. The other one is partial provision basis. Partial provision basis. This method partially recognizes the effects of deferred tax. By recognizing only arising timing differences. Only to the extent they will reverse. Only to the extent they will be expected to reverse. Full stop. The method accounts for current tax in full. The last one is full provision basis. It recognizes deferred tax in full. Irrespective of whether or not the arising timing differences are expected to reverse. Irrespective of whether or not the arising timing differences are expected to reverse. This is the method recommended by IAS 12. This is the recommended method. It is the recommended method by IAS 12. It is the recommended method by IAS 12. Then below that you write causes of temporary differences. 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 Number 1. The accountant recognizes depreciation of non-current assets. The accountant recognizes depreciation of non-current assets. While on the other hand, tax authorities recognize capital allowances. While on the other hand, tax authorities recognize capital allowances. Number 2. The accountant recognizes fair value adjustments. The accountant recognizes fair value adjustments. Into brackets, revaluation of assets. Into brackets, revaluation of assets. While tax authorities value assets at cost. While tax authorities value assets at cost. Number 3. The accountant treats inventory. The accountant treats inventory at the lower of cost and net realizable value. At the lower of cost and net realizable value. While tax authorities value inventory at cost. While tax authorities value inventory at cost. Number 4. The accountant treats research and development cost. The accountant treats research and development cost as an asset by capitalizing it in the period it was incurred. By capitalizing it in the period it was incurred. Number 5. Number 5. The accountant recognizes provisions. The accountant recognizes provisions. E.g., for example, provision for doubtful debts, provision for doubtful debts, provision for discounts, etc. While tax authorities only recognize specific provisions. Only recognize specific provisions. Number next, I think number 6. The accountant maintains his records. The accountant maintains his records on an accrual accounting basis. On an accrual accounting basis. Accrual accounting basis. While tax authorities maintain their records on cash accounting basis. Maintain their records on cash accounting basis. On cash accounting basis. Therefore, those are the reasons, or those are the causes of the difference between the carrying amount and the tax base, which eventually results to a temporary difference. Now, as you can see from those points, generally temporary differences are caused by the difference between the accounting principles and the tax principles, because these are the provisions of the accountant or the accounting principles, and on the other hand, we have the requirements or rather provisions of the tax principles. And as a result, a difference arises which is known as a temporary difference, and that temporary difference is the one which results to deferred tax. Now, I want us to use a past paper question to demonstrate the concept of deferred tax, to demonstrate the deferred tax concept